Our next guest says that a soft landing may be the worst case scenario because at least a temporary selling reprieve, though, may be nearby. Canacoord Genuity's chief market strategist, Tony Dwyer, joins us this morning. Tony, it's great to have you. You have been cautious, I would argue, for a good portion of the year. Is there a sense that this market is sort of moving your way?
Well, it's kind of the good portion of the last year and a half. Carl, as you know, I'm kind of known as the perma bull, and it's been the opposite for the last year and a half. And it's one really simple reason, and it's higher rates. So, earlier Mike talked about the corporate credit market holding in great. And people like me love to come on and talk about the study of how spreads and corporate spreads are doing well, and it's not indicative of any kind of real slowdown. But somebody better tell a CFO who's now raising money in high yield at 8 3/4 that it's okay because the spreads are narrow when it's up from 3 3/4 at the end of 21.
Right. So I guess the point, Tony, is that financial conditions are tightening, even if spreads are okay, they're tame, and if you're a corporate credit buyer, you can hedge it out in treasuries and you're still happy.
Yeah, Mike's, we've done this a long time. Every once in a while, we got to throw a little bit of common sense in here. I run a household, right? It's going to cost me, my mortgage expense would be so much higher if I had to take out a mortgage now. There's one thing, whether it's a soft landing, a no landing, a hard landing, whatever kind of landing you want, there's always a catalyst that takes you out the other side of it. And it's an improved outlook for money. That improved outlook for money always comes from lower treasury rates, lower mortgage rates, and lower corporate rates. And right now, as you know, we're making a cycle high for all of them. But to your point earlier, Mike, it's a really important point. Yeah, the S&P is down 6%. The equal-weighted S&P is flat for the year, and the average stock in the NYSE is down 29.3%. So the idea that people like me are going to come on here and say, now run for the hills because the market's starting to weaken, it's already been extraordinarily weak. So what I think you want to do is look for when bad news becomes bad news and be ready to attack that kind of weakness. And we're getting closer to that point.
I mean, it does seem, Tony, like the trend is to be more negative. You've got strikes, you've got a potential shutdown, you've got a student loan resumption, the payments resuming. I mean, it just seems like there's not a lot of options to be real positive, even if each one of those doesn't have a super significant impact overall put together. It doesn't feel great for sentiment.
That's really, I think, Courtney, that's exactly right. It doesn't feel great. So if you talk to somebody that has student debt, they haven't had to start paying it yet. But if you ask them if they've adjusted their budget on the fear of paying it, they have. And their credit card rates all those things are there. But that's why the average stock's down 29% from its 52-week high. More than half, almost 55%, according to my friends at Ned Davis, of NYSE stocks are down more than 20%. So some of that is going to be discounted. There's really three phrases of this game as you talk about economic weakness. There's when good news is bad news because it means a tighter Fed. We got that in 2022. Then you get good news or bad news is good news because it means the Fed's going to stop. We were in that into the summer of this year where the market had rallied over 20% off the low. But then you ultimately have to get, unless there's a dramatic, significant, and sustainable improvement in those three areas of credit, you ultimately got to get into that bad news is bad news. And that's when you want to look to take advantage of the opportunity. So, Courtney, going back to what Carl suggested, that I've been defensive for a while, yeah, we call it light and tight. We want extra cash, not extraordinarily defensive, because we want to be in a position to take advantage of a whoosh or some kind of economically fear-based swoon that's likely to come when you're having, historically high margins. Expectations for earnings, I think, for next year are out of whack too high. And the earnings yield in the S&P 500 is roughly equivalent to a risk-free rate. That's when you want to get prepared to attack the market, not to actually just jump right in.
And then, Tony, I'm going to make a counterpoint of the question that I just asked. If we could just play a soundbite from Neel Kashkari when he spoke on Friday about how consumers really have remained resilient. Take a listen.
I would have thought with 500 basis points or 525 basis points of interest rate increases, we would have slammed the brakes on consumer spending, and it has not slammed the brakes on consumer spending. It continues to exceed expectations.
So then how do you account for that, right? All of these sort of negative pressures, negative sentiment, yet consumers are still out there spending, even if consumer discretionary stocks had a really bad week last week.
No, they've had a really bad time outside of the biggest ones. But I would suggest that the Fed is going by bad data. get this one. So we did a study. We got the idea from Ned Davis, but we went back and we looked on the BLS website. You can find something called the initiation survey rate. That's when the Fed sends out data to payroll. For the payroll number we get every month. The initial response rate pre-pandemic was somewhere north of 65%. So they send out the survey, the business responds, 65% of the businesses respond. After the pandemic took place, that's dropped into the low 30s. It's been as low as 29%. So the Fed is going by very inaccurate data on their initial take. And I think that happens in the household survey that comes from the Census Bureau. So my whole point of this is we're kind of in a microwave market and a slow cooker economy. It takes a while. But people like me come on every day. You have 50 guests talking about how what the consumer's doing. When we look back, we're going to say, oh, yeah, rates went up to over 5%. Consumer credit was weakening. And corporate rates and mortgage rates stayed high. Yeah, that's why things got hit. So I think, again, Courtney, the really most important point is it's already hit so many stocks. The Russell 2000 has been smoked. Now's not the time to start getting nervous. I think now is the time, as bad news becomes bad news and gets priced in, that you want to look to be more aggressive in those areas that are early cycle stocks. It's just a little bit too early yet.
Good stuff, Tony. Appreciate that very much. And we'll see if we get a shutdown, Fed will have no data to go on, which some argue
right.
will keep them on the sidelines. We'll see.